Are you using short call options in your trading? Hi, I'm Larry Gaines, Paracycle Trading, and in this video I'm going to show you how to use short call options to hedge a position. So first off, to me trading really comes down to first direction and then the trade construction, which I like to usually use options. So for this particular trade, yesterday we set up a trade with Alibaba. So basically it had been momentum had shifted up. You can see our momentum flow indicator, and then on our hourly time frame, we were in a volatility squeeze. This is where the market's consolidating. It looked like it was going to trigger to the upside. So we had positive momentum, cycle 1 and 2 on the hourly. We had positive momentum on cycle 2 here with momentum here on the hourly. So we took a trade setup, and also you can see price had been consolidating here on Alibaba at the 618 retracement. So that's a key Fibonacci level right here. So when you look at Alibaba, let's just zoom out here so you can see the trade setup. You can see that it had a high to low, and then we had the 618. So very important Fibonacci level. So usually a lot of times, just a high percentage of the time, when you clear the 618 and then hold it, consolidate, then it's usually going to go to the next prior high, and then up to the next target level would be the 1272. So we were looking for a target up to 148. So we did a call debit spread. But always knowing, having a management plan, our plan of action, if this started to break down today or tomorrow, whenever, we were going to convert it by selling a call credit spread against it, and then maybe selling another call credit spread to convert it to what we call a call ratio butterfly. So it's something that we've termed opportunistic hedge management. So let's take a look. So the original trade set up yesterday was buying the July series. This is expiration a week from tomorrow, the 143, 147. We were looking for a target to 148, so we put our price on our call debit spread at 147, just right in front of that. $1.45 debit. So this was looking really good. At one point yesterday, this was up by about 25 cents. So then today, though, the plan was if the market started to fail and it started to break that 618 retracement, we were going to convert it to a butterfly by selling the 147, 152 and a half bear call credit spread against it. So you can see this shifted the risk from 145 debit down to 94 based on the credit received. And then when it started breaking through the 8 EMA, the next plan of action was to sell an additional credit spread to bring in more credit to offset the potential downside. So sold one more of the 147, 152 and a half at 25 cents. So now we've converted our downside risk to only $69 from 145. So a couple different ways to trade it. We could close out the debit spread, take a loss there, leave this on. We could sell another credit spread, or the market may turn around and come back up. And if it was go back at 147 next Friday, this could make over $300. So this is what we call opportunistic hedge trading or hedging. So it can really be beneficial to always have a plan of action in case the market goes against your original position. I also thought I'd do an update. On Monday, I sent out a video on this short trade setup on INTU. So we were in a volatility squeeze. I showed you on the scanner, breaking down below this trend line, breaking the 618. Here again, it's at 618. So breaking that, so shorted into it, looking for a target down here to 1272 extension, which we hit today, and used a put debit spread. So let's take a look and see how that turned out. So you can see the trade set up on Monday was the July 21 monthly 135, 130 vertical put debit spread, paid 84 cents. And you can see right now it's currently trading at 238. So it's up, over $150 per spread. So that's on INTU, and that was another spread trade based on direction, and in that case, direction to the downside. Hope this helps. Talk to you on my next video.